Hello everybody, welcome to the TraderMerlin show. As in case you didn't notice, I had to modify our intro song there a little bit. Hopefully Van Halen won't come after me for royalties or copyright infringement. But rest in peace, Mr. Eddie Van Halen. Pretty sad to hear. I mean, Corey and I could probably talk for hours about how that guy's impacted our lives and influenced our lives. So sad to see the guy go. Throat cancer. It's funny because I saw a video today where he's playing Eruption, one of his classic guitar, just Shredosaurus opuses. And on the neck of his guitar, he's got his little cigarette there. So note to everyone, stay away from cigarettes. Bad, cause of cancer. All right, the show for today, guys, is going to be managing an options trade. It actually comes from a question from Eric asking specifically about options and kind of how do we get manage an options trade the same as an equity market. And I thought, you know what? I could go into that one myself, but why not just bring in somebody who's just knee-deep in options all the time? And, of course, I'm talking about none other than Corey Lane. So, Corey, how you doing today, buddy?
What's up, party people? What's up, Merlin? How you doing, man?
I'm good. Other than the Eddie Van Halen thing, you're a rocker. He had to have been a part of your life.
1,000,000% was he a part of my life. I mean, I never knew him personally. Some of my really close friends do know him very personally. It's a sad day, man. I mean, we had Neil Peart a couple of months ago, also cancer, I believe.
Yeah.
And no one knew about that. And then I didn't even know Eddie had cancer, but I know he's been bad. I mean, he's been smoking and drinking his whole dang life, so it's only a matter of time, right?
Yeah, lived hard, died hard, I guess.
Live hard, die hard.
All right, let's. I'm going to go to listener question here, and the one I'm going to start with is from this gentleman named Eric. I'll put it full screen so everybody can see it. Eric says, do you manage an options trade the same way as a stock trade? And I thought this might be interesting for you and I to go back and forth on because, you know, we don't want to get too deep into trade management. Obviously, that's going to be for classes at Traders Army or et cetera, but like the full details of it. But there certainly are some high-level pieces and elements I think would be good for Eric and others to understand the similarities and the differences between managing an options trade versus an equity trade. So I'll let you start down the path, and we'll see where it goes.
Yeah, so super fun. So the short answer is, yeah, I always say the first thing you got to consider before ever trading options is this. And I would like everybody, if you have a way to write it down, write this down. If you don't have a pen to write it down, come back and watch this on recording. But a good option trade always starts with a good stock trade. So we always consider the stock first. I never search for options positions to trade first. I always look at the best stocks. I try to find the best, areas to buy and sell, and then we build the option trade around that. So once we build the option trade around what the stock is expected to do, the answer is yes. I'm going to manage that option position in a very similar way that I would have managed a stock position. As a quick, for instance, Merlin, I can share my screen. Is that okay?
Of course. Feel free.
All right. Let's see. Which one do I want?
And as you bring that up, let me just real quickly add here. I think it's important because we get this separation from a lot of people where they say, oh, I'm going to manage the options trade itself. But what you're just saying, and I want to make sure this is clear, is you're basing that options management on the underlying. Because a lot of people may say, well, there's a stop loss that I'm making on the option per se, but it's really more important to focus on the underlier because that's what's going to be responding to those levels, those zones, and those pieces that are making the trade for you in the first place.
Yeah, that's exactly right. What's interesting is the moment I shared my desktop, my entire Thinkorswim platform decided to go a little bit slow on me. Okay, so here we go. So an example of a trade I have set up this morning from my trading room. We had a trading room this morning every Tuesday, and I found General Mills. And the thing that was the most attractive to me about General Mills is we have this momentum divergence here, which is pointing to a more potential bullish outlook. We had some of this near-term supply, all this resistance kind of taken out through this breakout. It's kind of almost cup and handle-ish if you see this little rounded bottom here, Merlin. And then it broke out to the upside. Now, I didn't take the breakout, but I would really love to take the reversal back down to 59.93. Being an option trader, I'm not going to buy the stock. I'm going to buy the bull call spread. I'm going to buy a spread trade on this. But I'm still basing my entry off of 59.93 entry price. If the price of GIS goes below 58.44, that will trigger closing the option trade. No matter what the option trade is worth, I'll close it the moment I'm proven wrong. And the thing about options is, at what point are you proven wrong on the option trade? Well, you're proven wrong the moment the stock goes against you. So the stock going against me is 58.44. Similarly, if I have target prices above, I'm going to trigger closing the option position based on the condition that the stock hits those target prices, regardless of what the option spread might be worth. And we can anticipate when we build the spread, we can anticipate at our entry price, at our stop price, at our target prices, exactly how much we'd stand to lose and exactly how much we'd stand to make based upon the option spread. But the option spread is just how we're looking to make money. The trade is all triggered off of what the stock is doing. And it should be traded that way. Because anytime you put orders to buy and sell, to close your option positions based upon the premium amount, what I've found is, especially within the first half hour of the day, when the market's really volatile and the spreads on options get really wide, you're oftentimes going to get your option position closing out prematurely. When you say, oh, I should still be in the trade because the stock is still technically doing what I thought it was going to do. But I got hit with wide spreads, and I had this order waiting on the premium to close, and it closed prematurely. I can't tell you how many times I've shot myself in the foot, figuratively, but with leaving a bunch of money on the table because I didn't place the order based upon the condition of the stock. So that's always been the best way in my experience to trade the options based on the stock price.
Yeah, and I think that's a challenge for a lot of people because when you're in that options trade, you're looking at your P&L for that specific options trade, and you're saying I know that P&L kind of going into it. So meaning when I set up that trade initially on the underlier, which is what we should be doing, and you guys can see he had all those lines drawn out. Those are the specific target prices where he's saying, all right, if it gets to these levels, then there's going to be the profit or loss I'll have for that specific option setup, and therefore just let it run its course. Don't worry about the option itself. Just focus on the underlier, which is, I guess, step one of trade management here for options.
That's right. That's right.
Now, let me ask you real quick before we jump in. You mentioned you're doing a spread trade on this. If you really felt that 59.93 level was going to be a turning point, that we've now rounded the corner on General Mills and cereals and be flying off the shelves. I know your kids probably eat tons of Honey Smacks or Cheerios or something.
Cookie Crisp.
Is that what it is? Straight sugar, baby.
Cookie Crisp.
Why spread and not just buy directional if you were really confident that was going to move to the upside?
Oh, that's a fantastic question. Biggest reason is due to time and volatility expectations. So when you just buy a call, you're going to have a delta position that allows you to make a certain amount of the money based upon the stock going higher with infinite reward potential and defined risk. And so that's the benefit of buying a call option outright, is you get the infinite risk profile with defined risk in buying the call. The downside to that is you have exposure to time decay, which we know options, when you buy the call option and take a directional position, you're going to lose money every day. So we know that. The closer you get to expiration, the faster that will accelerate. The bigger impact, though, that I want to be mindful of is the effect of volatility on that option. So if the stock price goes up, generally speaking, volatility tends to fall. And so when volatility falls, and we're not exactly as low as we've been, I mean, right now we're at 27% volatility. We've been as low as, we've been technically as low as 14, but really low volatility for this stock is about 19. So we could drop 10 points in volatility, which if you're not careful, check this out. If you were to buy an April option, let's just get rid of my spread there for a second. If you were to buy this April option, the $60 call, the volatility exposure on this is $17, right? Per 1 point move in volatility. So if the stock price goes up from 59 to 62, right? That's, roughly a $3 profit.
Yep.
You'll make 50 cents per $1, so you'll make $150, right? On just delta. If it takes you, let's just call it 20 days to get there, it's going to cost you almost $20 in time decay. And if volatility falls 10 points, each one of those points will cost you how much? $17.
Right.
So there's another $170 in losses, which will, and plus the $20 in time decay. So how do you make money if you made $150 in delta but lost $190 in theta and vega? You'll still end up losing money even though you hit your target.
Right.
Quality. So I'm a huge proponent of spread trades because it reduces your exposure to the stock price going up and down. It does do that. That's delta. It reduces your theta exposure. It reduces your vega. Well, by how much, you ask? Go ahead.
By how much?
Tell
me. Pray tell.
There you go. Tell me. By how much? Check this out. If I just do the spread trade, it reduces the delta to 32. So from 50 to 32. So it reduced it a little bit. Theta got cut by 2/3.
Yeah.
And volatility exposure got cut by 2/3. So I drastically reduced my exposure to things that I know are likely to hurt me, while still maintaining exposure in delta, which is the one thing that's going to help me.
Right.
So I much prefer spread trades over just buying calls and puts. And people say, well, yeah, but your profit potential is limited. Of course it is. So is it in every single other trade that you have that also has a target to take profit at X price. Just because something has infinite profit potential in a theoretical environment doesn't mean you're ever going to see infinite profits. Mm-hmm. So if you're going to have targets in place anyway, you might as well buy the spread and reduce your exposure to things that may hurt.
Nice. It's interesting. You're like the first one who's actually broken that down, just straight math, right? Because most people break down the directional versus spread and say, well, directional you stand to make a lot more. With spread, you're giving up some of that, but it's a little bit safer. And it sounds nicer. But when the number's there in your face, it really does make a good argument why spreads are probably the better way to go. Thank you.
Yeah, and I got to tell you, for those listeners out there who don't have, if you're trading options and you're trying to, figure out your risk-reward profile and what your trade looks like, I'm going to tout Thinkorswim for this because they have just built the best, from what I can find, one of the better option analytics platforms there is. It really helps you understand the impact of all these factors if you learn how to use the analytics. Even if you don't trade with Thinkorswim, it's a great tool to analyze a lot.
Tom says in here, Thinkorswim allows you to trigger the close of an option position based on conditions, including the underlying. For example, sell my iron fly at market when SPX is less than or equal to 3,400. So these you can actually program in those types of predefined strategies.
Exactly. Yeah, you can predefine everything and say, on this condition do that, on this condition do that, on this condition do that, and it'll handle all of it, which I love.
Yeah. Well, it certainly takes a lot of the sit in front of it and stare at it all day long out of the picture.
Yeah, I know for certain that if I sit in front of a computer screen and stare at trades, that I will tinker and likely screw it up. So it's best for me to just set it and walk away.
Nice. All right, so we can go back to your list. You were starting a list, I think. You had trade management kind of checklist, and you said number one is based off the underlying stock, which it's abundantly clear with that example on General Mills. What would your step two be?
To managing the trade? Well, I mean, it's pretty straightforward. So if you want, Merlin, I can actually show the group the actual way that I like the idea of at least setting up the original order. A lot of people don't know that you can set these orders up pretty simply, but once the order is actually in, right? So for instance, if I just go ahead and make this an order and I look to close it based upon, I'll just use one contract and I'll use one order to close it. One thing that I'll do is I want to make sure that I only get in this trade if the price hits my entry price, which is if General Mills is ever at or below 59.93, then that's my entry price. You can trigger this to buy at the market price. And because the General Mills, generally the spreads aren't incredibly wide, I'm okay looking at a market order to get into that position. Mm-hmm. And then on the way out, good till canceled, I click over on this cog here on the far right, which is, they like to hide that little cog, which is not fun. But then you can place your two conditions in here that says, well, if I'm in, send this next order in that says if the price goes below 58.44 or if the price is ever at or above, this is just the order entry here, 62.93, we'll just call that our target one.
Right.
Then close that position out at the market price. Now, if I save that and I send that, I've got my entry price in, waiting for price to hit the zone. I got the stop to follow that up, and I got a target to follow that up. What exactly do I need to manage from here?
Yeah, no, I get it. I mean,
there's really nothing to do. Now, with that being said, what happens if prices, drop into that level and then they start to move away? And I have multiple contracts on. What would you do if you owned the stock and you had multiple shares and you wanted to close some of them out at 62.93 and you wanted to wait a little bit longer for target two? What would you do?
Scale out.
Scale out. So we'll scale out the option position. What else would you do with that original stop? Would I keep the stop all the way down here?
Nope.
No. Not. So as easy as I would go in and be able to, drag this line up and say, okay, I'm going to move my stop up to break even once General Mills moves call it 2-to-1 in my favor, which is actually pretty normal for me.
Okay.
2-to-1 in my favor, I'll move the stop up to around break even. Well, when you come back to the original order, which would then be placed, it's still staged right now, but let's go ahead and place it. Why not?
Why not?
Why not? And then I come over here to the working orders, and I come over here to say, let's see, where's that order? Right here. So General Mills, waiting condition, waiting trigger. So this is the closing order. When it's time to move the stop, I do a quick cancel replace. And I come down here and I go to the cog where I had the original order in, and I just say, I don't want my stop at 58.44 anymore. I want my stop at 59.90.
Right.
I'll just put it there, right? Save it, send it again, and now all I did is I changed the condition under which my option spread goes away. So that's adjusting the stop up. So the exact same way that I would manage a futures position, a stock position, a currency position is the exact same way that I manage an option position, contingent upon the underlying. Do this with the option trade.
I like that you threw in all the set and forget aspects of it. A lot of people don't want to sit there and manage a trade all day long. I'm a good example that I have a lot of other things going on. So a lot of the stuff I do is off conditional orders. And for those of you who might not be familiar with conditional orders, I highly recommend them, especially the way that Corey just presented it here. Very simple. He's on a daily chart in this example, but you might be looking at shorter time frames. It's a little more challenging on the shorter time frames because obviously you have to be there and changing it as it goes. But this could be a once a day where you end of the day you just come and check it, move up your stops, and just manage that trade that way. So simple and easy, not overthinking or overworking it.
Yeah, kind of similar. I mean, we have this short TLT position that things are moving in our favor. We move the stop. A short Cisco position, we move the stop. Right, the same way you would move a stop on any position, just move it on your option.
Nice.
It's easy, right? And then
Chuck is in here today. Chuck, when are you going to come on? I'm trying to get Chuck on the show, but he's a little shy. Chuck, come on, man.
He can come in right now.
I don't know if I have the technology to do a three-way right now. Well, that sounds awkward.
Whoa.
All right, so you got Cisco up. You want to walk through Cisco? I got some questions coming through, but we got Cisco up here, so why not?
Yeah, I don't have anything specific on Cisco. It was just, you can see where my red line was. The red line used to be up here above this basing. We took a breakdown short, and we just moved the stop down on Sunday nights in our Sunday night trading room to above this recent pivot high. So it's an option trade that says if prices keep falling, we'll stay in. If it goes against us and goes above this red line, the conditional order will pop us out of the option trade.
And in principle, you're just hoping this thing keeps you in it forever. Let's watch Cisco keep on falling, and great, ride it all the way to zero. Now, we know it's not going to zero, but in theory, you could just keep these moving your stop loss down in the situation and, hopefully break that 33.98, keep on falling.
Yeah, and by the way, if it's a spread, let me give you, for instance, on that GIS again, because we're not in that one yet, but if it's a spread, here's what I like. We talked initially about time decay working against the option position, right? But in a spread trade, check this out. This is what I love, is if you actually get the move in your favor, right? Our current price, 59.93 would have been the entry. If prices actually start to go up like you expect, this purple line here is our real-time risk profile. It displays how much money we would make if we're right and how much we would lose if we're wrong. And it'll display it on the vertical axis on the left in dollars. Mm-hmm. But if you look at the purple line's relationship to the black line's relationship, the purple line is today, real time. The black lines is at expiration. So anytime the purple line is above the black line, time decay is working against the position. So the longer you're in the trade, the more you're putting at risk. But anytime the purple line is below the black line, time decay is actually working for you. So another reason why I like the vertical spreads is because you can actually shift from negative theta to positive theta and actually profit from staying in the trade longer, which is really unique to a vertical spread. You don't get that in many spreads.
Right. Yeah, that's usually the exact opposite.
So you can get debit position and get paid to wait.
I'm down. Sign me up.
Down.
Very few people I've seen use these types of graphs here, these kind of P&L probability graphs. How critical are they to you?
Very.
Yeah.
And the graph is a little less critical at this point. I mean, I've been doing this now for going on almost 16 years. The graph itself is a little less critical, but when I was learning options, the graphs were super critical because it's not inherently obvious that if you pay for a trade, if you pay a debit, you think, oh, I'm paying for an option trade, I must be losing money every day due to time decay. I must profit at any point if volatility goes up. But that's not always the case. And these risk profiles, these graphs here, will basically display for you how delta, vega, theta, even gamma affects your position now and through the life of the position. So from a learning perspective, these are an absolute must. In my classes, I would always actually practice, we practice drawing them by hand, actually, Merlin.
By hand? Who does that? Are you going to tell me you're like studying calligraphy too? Come on, man. Nobody does stuff by hand anymore.
Yeah, we do. I don't know, man. My kids are learning how to do math by hand. So.
Oh yeah, with the Common Core garbage they're teaching? Forget it.
Yeah, but they're learning how to do it by hand. You know, one would say, well, why would I learn how to do it by hand if I could just use one of these? Well, you will use this, right? You will rely on your options risk profiles. But have you ever done this where you're typing in some figures to do quick math? And the number that comes up, you're like, no, that can't be right. You ever do anything like that, Merlin?
Oh, no, I never make mistakes, Corey. I'm perfect.
Yeah.
All the time. Like, wait a minute. Did I do to multiply or divided by? Yeah, that can't be right.
But the only reason that you know that that's wrong is because you actually know the math behind it.
True.
You're just not willing to do it. You're willing to use this. You know the math behind it. So if I pull up an option trade and I look at the P&L and I'm like, that's not right. That means I made a mistake somewhere, and I know that I did, and I can go find it because I know that should be telling me a different number.
Yeah.
Right? So these are critical from a learning perspective.
Let me go to a couple listener questions here. Ryan says, do you not recommend trading options on TradeStation? I mean, obviously you have a preference with Thinkorswim. That sounds like your bread and butter, but is there a reason for it? Is there problems with other platforms?
So I've used Thinkorswim now for almost my entire trading career. So I'm the most familiar with it, number one. Number two, when it comes to trading with TradeStation, while they have gotten a lot better over the years, there's certain features that you can't do certain things in TradeStation that you can in other platforms. For instance, they make it very difficult to have multiple exit orders working at the same time on an option position. When I say difficult, I mean impossible. As an OCO order, and there's going to be times where we want OCO orders to be waiting to close out our positions,
right?
And so they don't let you have two working positions on the same stock on an option position, and so you have to choose: do I put a stop in on this trade, or do I put my target in on this trade? Because I can't have both working, and to me, that's really inefficient and very dangerous. It takes away from the potential set and forget.
And I brought this up in the past, which is with this you have with Thinkorswim. I mean, their initial platform was built specifically for options, so that was all features and functionality were for options, and then later on they built on equities. So some would argue that their equity in other markets aren't as good as other platforms. So if you're looking at options, from what I've heard from most people, is that Thinkorswim is the way to go. But I do my options on TradeStation and E-Trade and Ameritrade, so. Yeah.
And I'm guessing, but E-Trade is probably more well-suited than TradeStation.
For what I do, yeah. Like, I don't use the graphs like this. I'm just purely directional. I look at something and say, okay, I feel like we're coming into a great demand zone. Great. Am I overpaying, underpaying? Fine, I'll buy some. That's the extent of my options. So.
Sure. Yep. And that's okay.
Yeah, I'm elementary. I try to keep it simple. But one day I'll get to your level.
Well, if you don't have to, you don't have to. I mean, if you're just crushing it. But the thing that I like about having the graphs is it's so frustrating to be in a position and lose money and not know why.
Yeah, right.
And so that happens all too often with option traders, to lose money or not make what you expected to make and not know why. And if you don't ever dive into why, then you'll never be a better trader for it. And so that's where I think these things come in super handy.
Question from Tom. Tom says, what do you think about adjusting a trade when it moves significantly in spreads and even more importantly with like iron flies or iron condors?
Well, there's two types of moving significantly. There's moving significantly in your favor, and then there's moving significantly against you. Generally speaking, I mean, the only thing I really adjust when something's moving in my favor is I adjust my protective stop. I don't adjust the trade necessarily. I just go with, this was the original trade. This is what I expect to lose. This is what I expect to make. Close it out if it gets to either one of these prices. It's done.
Yeah.
Covered calls, for instance, is one that I do adjust. So if I own, like for the longest time, I owned SLV. I'm actually looking to get back into silver if it pulls back a little more. But I own silver from 11. And I started writing covered calls on it around 20, 21, 22, selling calls above current price. And then the price would still rally. And I'd change my mind. I was like, man, I didn't expect prices to get that high. So I'll buy back those calls, roll those calls up to a higher strike price and out into another expiration to capture more premium and repair that and expose more profit potential in the underlying. Mm-hmm. I'll repair those by rolling up and out. Similarly, I'll repair selling put options with this intention of collecting premium. Sell a put option where you're willing to own the stock or where you just want to collect some premium. If the price is dropping, if I don't want to take that loss and I still think that one of these demand areas may hold, I'll roll the puts out and down, right, down in price. I'll buy the original ones back I'm taking a loss on, roll them down to a lower strike price, but out in time more. When you're rolling for a credit, you actually make up all your losses, plus you get the benefit of extending that out a little bit longer in time. So I'll repair those strategies. Mm-hmm. But generally speaking, repair strategies, trying to fix something that went horribly wrong in my experience, and maybe I'm doing it wrong, Merlin, but in my experience, I usually make it worse. Most people will usually make the trade worse if they try and fix something that was already bad in the first place.
Yeah, that brings up the old, the double down, the, adding a losing position type things. Yeah, I mean, generally, if you find yourself in a position that's railing against you, the best thing to do is just jump ship, get out, and move on to the next one, and hopefully learn from it.
Yeah, and I don't know if it's just me or if this is generally speaking, but I've had a lot of students tell me in the past, I feel like when I made the trade in the beginning, I was clear-headed, I was on the sidelines, I was objective. But now that I'm in it and I'm trying to find a repair for this, I can't be objective. Right. I'm emotional because I'm losing money and I want to stop the bleeding. I want to fix it. That's all I want to do. And then we never make good decisions in that environment.
No.
That's why generally people typically make it worse. So I'll be done, reevaluate.
I agree. Let's see, another question. This is from Mario. It says, Corey, do you /trade credit spreads on the SPX that expire the same day? If so, do you prefer taking premium at the beginning or towards the end of the session?
The answer is yes. I do like the SPX daily trade. I'll look at it early in the session, but I generally tend to find that around 9:30, 10 o'clock. I'm on the West Coast, so 9:30, 10 o'clock my time, which is 1 o'clock, East Coast. Yeah. That's usually when I'm finding that I like to execute. Well after the open, so we're kind of got away from a lot of the volatility. But generally, if there's enough premium, and I always look for an inside day too. Look for an inside day on the SPX, and oftentimes those will pay out really nicely.
Nice.
Of course, today we had some end-of-day volatility. But,
gotta love that. You gotta love one tweet that just crushes a market.
Yeah.
Love it.
Yeah.
All right, guys. There's a couple questions here I'm gonna get to. Let's go full screen over here. This one's from Jeff. Jeff's actually sent in 2 of these, Corey. So we'll see how we go one by one. He says, can you ask Corey what's the best way to search for stocks that pay well for cash-secured puts? Also, I sold a put on SQ this morning and never got filled. How come? I sold a put on DraftKings and was filled instantly. So we got a couple different things here that we could discuss. Let's start with the Square one, because he says, I sold a put on Square this morning and never got filled.
Okay. What put?
Right.
Number one, I would ask, what put option did you try to sell? What price did you try and get for it? Because ultimately, the market's going to, when you look at selling puts or whatever, if you'll go to a 10-day option, you look at Square, and we'll just go a little bit out of the money on these. Depending upon what you were trying to ask. If we were trying to sell these 160s and we were asking $170 for these, we probably wouldn't get filled because we're asking too much.
Yeah, let me explain that real quick, Corey. So the guys yesterday on the show, if you look at Corey's screen right now, his cursor is in between the bid and the ask. It's literally sitting on the ask column. Remember, the ask column is the lowest price that somebody's willing to sell it for. The 161 next to it is the highest price that somebody's going to pay for it. So Jeff, if you tried to sell it at 174 thinking that you're going to get it at 174, you might, but you're probably not, because that's other people lined up to sell it there. Now, as Corey mentioned, if you put 170, you're now in between the 161 and 174, so you might get it, but still probably not. If you put it at 161, you're going to get it most likely, unless that person cancels right away. So he says, he actually responded, Corey, he says, it's actually the Friday, expiring this Friday's.
170s.
Oh, you saw it, okay.
Yep. I got the chat box up here.
Oh, good. So yeah, you got a 19-cent spread. That's probably why you didn't get filled.
So depending upon where you tried to get filled at, what price you tried to get filled at. I mean, there's plenty of interest. This could also be a contributor. If you don't have a lot of open interest, you're kind of trading against yourself or the market maker, I guess, if you want to call it that. But yeah, there's plenty of interest on these, so you shouldn't be having trouble from that standpoint. But for that, it would have to do with the bid or the ask. I'm not sure what you tried to get filled on. But that's normally what happens.
Yep.
If you're trying to ask too much, you're not going to get filled.
I'll tell you what I do when I'm buying these or selling puts or whatever. I'm usually going to cut that spread in half because surprisingly, you'll find just randomly I'll get filled. So right now it's a 20-cent spread. So let's say I did a 170 and I was trying to sell the 170. There's no buyer lined up. You see the highest buyer there's at 160. Well, I might get filled, but that's an if. The 160 I'm going to probably get filled out right away because someone's literally standing there saying, I'll buy it from you at 160.
Yeah. And, I find that if I'm 50% of the way through the bid and the ask, just like you, Merlin, I do find that many times I get filled pretty quickly.
Especially when you have open interest that's high and it's a good liquidity stock, right? That's an important one as well.
Yeah, exactly. In fact, if I find that you get filled too quickly, you didn't ask enough. So I always get a little more aggressive, Merlin, and say, well, if 170 is the mid, will you give me 172? And I'll wait a minute. And I know I probably won't get filled, but then I'll back it off 1 penny at a time every few minutes until I do get filled. Because if you get filled right away, you didn't ask enough.
Yeah, exactly. It's like selling your house.
Like, what? I got a first day offer, all cash. You didn't put the right price.
Yeah, should have gone higher. I should have offered more. All right, and then the second part to this. Well, there was kind of two there. When you're looking for stocks that pay well for cash secured puts, I guess that's dealing more with the Greeks, right? As far as looking for premium and amount that you're going to be getting paid for those.
Yeah, I don't really have a way to scan for all the stocks that are paying good premium, because define for me good premium.
Yeah, right. I mean, good premium on GE might not be good premium for Tesla. Right? Yeah.
Which is not good premium compared to Amazon. So, one thing that you could try and scan for is higher implied volatility, right? But define high implied volatility. Merlin, I think we talked about this a few weeks ago. What is high implied volatility? Well, high for Square is 120%. High for Amazon is 60%.
Yeah, which surprisingly you would think it'd be higher, but
Yeah, but it's so what is high? A lot of times what I do, we have one of our members at Traders Army actually wrote an indicator for us that we use, which is really nice actually. It's based upon this IV rank down here, so it tells us if implied volatility is in the upper 20%, lower 20%, or middle 60% compared to the last 1 year of trading. So we can quickly know if implied volatility is high or low relative to itself. And so this indicator is nice, but you have to look through each chart to see which ones carry higher implied volatility. Or what we have is this, our members can download this, is we have the IV rank in the watch list over here. So what I can do, let me go with just a full watch list. So there's hundreds of stocks in here. I can sort by volatility. This LV2, LV3, and LV1 is just basically referring to level 1, level 2, level 3. So green space is level 1, white space is level 2, red space is level 3. So if I want to know where all my low volatility stocks are, I just sort by this column, and now I can scan these stocks.
Nice.
Right, and then if I want to search for all the higher ones, I can look for anything that's in level 3 or whatever. So this kind of narrows it down for me. But I still, going back to the original the original statement, which is every good option trade starts with a good stock trade. So just because you might be able to screen for good option premium does not mean that that is going to be a stock that you want to sell options on. You may look at the chart and say, oh, that's nasty. That's ugly. I hate that. What was the point of the scan then? So stock first, right option trade second.
All right, sounds good to me. Let's see. I wanted to. We could probably stop sharing our screen. Well, that's on you, so I'll let you stop sharing your screen. Tell me about your summit. I know you got quite a few people doing your Trader Summit coming up here, and that's going to be next week. So I figured you maybe want to talk a little bit about that.
We do have a summit. Yeah.
I'll even share this there. If you go to tradersarmy.com, guys, there's their Trader Summit. I'm seeing you and Mr. Chuck, who said a couple words today. He's quiet. He's shy in the room. But you also got Steve Champa, Mickey Moores, John Hoagland, Dan Hogeman, Justin Krebs, and John Rowland, who was on here just a couple days ago. So,
yep, yeah, it's a packed day. We're definitely packing it in, and there's a lot of topics from a lot of different angles. Some long-term investing and trading. Justin's going to be going into some of the differences between spot forex and currency futures. Dan and John are from Top Step Traders. So what we find is a lot of people tend to trade other people's money better than their own. Less emotional attachment to the money, maybe. I don't know what it is, but we have a lot of our members will actually go to Top Step Trader to leverage Top Step's money. They pay out 80% of your profits. They keep 20%. And every one of our students and members who have gone through the process of the Top Step Combine, which they're a prop trading firm. You have to prove that you know how to trade, prove you know how to manage risk, and then they'll fund your account, $30,000, $50,000, $100,000 account. And so we thought it'd be a great idea to bring these guys on to talk about what it means to, trade other people's money and how risk management works when that occurs and all that kind of stuff. And John Rowland, I mean, he's just the energy guy. So he's coming on. It's going to be an awesome day, and it's all day, so it's free. And we're not selling stuff, we're not pitching stuff. It's just a full day. We started doing these back when COVID first started.
Yeah,
as a way to kind of entertain people and give people, kind of something to do if they're, not working. When we have 8 million unemployment, something crazy like that. It's like, let's do something, right? So we started doing these, and then every quarter, it's like people seem to love them, so we just keep doing them.
Nice.
So the next one's this Thursday. Next Thursday. Sorry. So
yeah, the 15th. Thursday the 15th. Nice.
Yeah, we just asked that people register. That way we know we kind of have a head count because our Zoom room only handles 1,000 people. So the first 1,000 are in. Anything above and beyond that, you have to wait for the next one. And then don't take so long to register next time.
I've attended one. They're informative and fun. You guys keep it light and entertaining.
Yeah. So that'll be super fun. So yeah, anybody wants to come, it's open to everybody.
I love Chuck's comment. And we end the day by day drinking. Yes, it's that's how you're supposed to end things. Well, of course, it's at 3 p.m. Central Time, so it's a little bit early out here for me to be doing that. But yeah, I appreciate the thought there, Chuck. I gotta do my show. I don't want to get in trouble.
Yeah, right?
Yeah.
Now, if we had it on a Friday, you could just carry the happy hour over into your show, which I know you like to have a cocktail in your show every now and then, right?
I do. Every Friday. Actually, I had a guest the other day. He surprised me, like on a Wednesday. He cracked a beer. I'm like, well, I got to go to the fridge and have a beer now. I can't let you have a beer by yourself, buddy. So
that's right.
All right, Corey. Well, what else you got cooking? I know you got the Trader Summit. Obviously, I could say just go to tradersarmy.com. They get all the info they need about you guys. Yep.
It's all there.
Perfect.
Yeah, that's the next big thing we got coming up, man. So we're excited about that.
I am too. Maybe one of these times I'll get to attend one of or present at one of them. We'll have to see how it goes. I have strings pulling me in different directions.
I tried, man, and I'll keep trying too. That's the one thing you can count on. I'll keep trying, Merlin.
I appreciate it.
I'll get you.
All right, Corey. Well, thank you so much for joining us today, giving us some insights into trade management on options. We do appreciate it. I'm sure our viewers do as well. So thank you very much. Maybe I'll see you next month.
Dude, I'll see you again real soon, man. Thanks for having me.
All right, take care.
All right, bud. Peace.
Guys, that was Corey Lane of Traders Army giving us some insights into trade management. if you guys enjoyed that, go to tradersarmy.com. They also have their summit coming up on the 15th. Next Thursday will be their presentation. That's from 8 a.m. to 3 p.m. Central Time. It was fun and informative last time I was attending one of those as well. So, question that came in. I want to make sure I get to his last couple questions here. This was a follow-up from Jeff, just on kind of how this works. Jeff was asking, if I sell puts on SPY at 330, if there's someone on the other side of the trade, like in stocks or just a market maker. To answer that, it's somebody else on the other side of your trade. Someone bought that option from you. You sold a put, someone bought the put. They were betting it's going to go down below 330 most likely. Trying to understand how come I didn't get filled on the stock. I actually wanted to buy if price goes below my strike. Okay, so let me just real quickly show you guys here. I'll bring up SPY. We will go and look at... I'm going to put a line right at 300. Get rid of some of my old lines. We'll just go to 330, I think was the number that you mentioned. So I'll go data, change it to 330 so you guys understand the basic concepts of this. Okay, so let's say that you sold that 330 put, right? Doesn't matter what time frame, none of that matters at this point. It's just basic, simple math. You sold that 330 put, and basically what you told the world is, I am willing to buy it if it falls to 330. And you collected, I don't know, I'm making it up, let's say you collected $4 worth of premium for that, right? Probably less than that, but there you go. If price stays above 330, your option is just going to expire worthless, and you would have collected that $4 and just put it in your pocket. Done. If price gets down below, so let's say you have 1 month to expiration, but tomorrow, so you still have another month to go on the option, but tomorrow it falls down to 320. I think the problem here, Jeff, is you're thinking that you're going to now have owned that stock. Not necessarily, because the person who bought that put option from you has all the way until expiration to exercise that option. So you could be exercised the second it drops below 330, most likely to go all the way to expiration, or it's any point between now and your expiration date. So even though price might be currently trading at, let's say, 320, you can't do anything with that with the shares yet. You can't sell them. Even though you think you own them, you don't until that option is exercised. And that's up to the person who bought the put from you. That's why you're not getting those shares right away. So it's a challenging thing to understand. You have to understand that if you sold a put, you're saying, I want to buy it at 330 at this date. Let's say it's October 16th, right? You sold that October 16th monthly expiration. We might get below 330 by then. But someone may just let that option expire, and if it's 1 penny below 330, 229.99, those shares will automatically show up in your account on October probably 17th or 18th as they round out that option trade. So there you go. That's the basics of it, Jeff, on how that option would work and exercise. Hopefully that clarified things. All right, let me go to your economic calendar for the 7th, and I can wrap things up here. If you look at the 7th, we do have quite a few announcements for tomorrow, although there's not the major stuff. You've got crude oil inventories. You've got a couple FOMC members, which have been very active this week, as most of you guys have figured out. You have home price index for the British pound. They also have a RICS, housing price balance for the British pound as well. And that's pretty much it. You have trade balance for the euro, Swiss franc unemployment, but none of those are major market movers. Now, the interesting thing for us, at least for me here today, is we will be doing another webinar here shortly. I'm going to finish this one up, wrap this up, and I'm going to be going to, let's go to Trading Academy. I had it up there. This is going to be the webinar for today. Where did it go? Trading. Oh, of course, now that I want to bring it up here. Delete that and put that in there. All right, so basically I'm going to go to all my trading, not day trading. How about online? There you go. First one that pops up there, and you'll see there's a War Stories from the Floor with Bob Henner and Bill Henner and Bob Dunn. Got dyslexia out there today. That will be coming up in a little over an hour. You can see it's 2:44. That's going to start at 4 p.m. So I got about an hour and 15 minutes for this webinar. We're talking about floor traders and the floor trading experience. That should be exciting as well. So hopefully you guys will join us for that. As I mentioned, there's a ton going on. Again, we had Corey Lane on the program from Traders Army. Hopefully you guys enjoyed that session about a little bit of risk management, managing risk. Tomorrow we're going to have Sam Evans on the program. We got Matt Leising on the program on Thursday talking about Ethereum and kind of the massive heist that happened in the cryptocurrency world. It was one of the most groundbreaking thefts that have happened in the crypto space, happened on Ethereum, and the interesting things that they did to cover it up. So we'll talk about that. His new book came out on that topics precisely. So that'll be Thursday's topic, because Sam Evans will be tomorrow. We'll probably just do a whole bunch of chart analysis, because Sam just loves looking at charts. If you have anything you want us to analyze, do me a favor. You can send it on in at TraderMerlin.com. There's a little contact button. You type your name in there and just send me a question, picture, graphic, whatever. If you have positive feedback, do so as well. Hopefully you guys like today's show. Give me a thumbs up, and also go out there and put comments down below the video. That helps me out as well. All right, guys, that's going to do it for me for today. Thank you guys so much for joining us. I will see you in an hour and 15 with Bob Dunn and Bill Henner. I'll also, if I don't see you there, I'll see you tomorrow. Take care, everybody.